I want you to picture something for a second. We are in the middle of 2026. You pull up your financial news feed, and there is this massive, sustained tech stock rally happening.
Right.
And it is completely defying a broader rotation that's currently dragging down the NASDAQ. But when you look closer to see who is actually leading the charge, the star of the show isn't, a shiny new Silicon Valley startup.
No, definitely not.
It's not a company founded in a dorm room last year. It is a 115-year-old legacy giant.
Yeah.
I mean, we are talking about IBM.
It genuinely stands out as one of the most counterintuitive market narratives we have seen in quite some time.
Yeah.
When you think of a defensive rotation in a dipping market, you simply do not expect a century-old company, one that many just assumed was coasting on legacy maintenance contracts, to be the one setting record highs.
Right.
You don't expect them to be dominating the artificial intelligence infrastructure conversation.
And that paradox is really our mission for this deep dive.
Yeah.
We are unpacking IBM's 2026 financial analysis and their strategic investment thesis.
Because we want to understand how a company that built its reputation on, well, let's be honest, room-sized, seemingly stodgy mainframes.
Very stodgy.
Yeah, how they've quietly engineered this structural transformation into a premier hybrid cloud and enterprise AI leader.
It's wild. How does a company known for legacy IT systems manage to hit record stock highs, secure a $1 billion federal quantum computing contract, and just suddenly become the darling of the AI hardware space?
Well, to answer that, we really have to look past the surface-level narrative and dig into the actual mechanics of their business model right now.
Which is fascinating.
It is, because the numbers they are posting, particularly the first quarter results from this year, they tell a story of a massive turnaround driven by physical hardware, of all things.
So let's get into those Q1 numbers, because that was the massive aha moment in the source material for me.
Oh, absolutely.
Total first quarter revenue came in at nearly $16 billion.
Which is almost a 10% year-over-year increase.
Yeah, comfortably beating Wall Street consensus. And they posted their fourth consecutive earnings beat. But the absolute shocker here, the detail that literally made me stop reading and reread the paragraph, was the IBM Z mainframe revenue.
Yeah, that was wild.
It skyrocketed by 51% year over year. I mean, what?
That specific metric caught the entire street off guard. And it didn't just drive top-line revenue. It drove a massive surge in profitability.
How massive?
Well, their infrastructure segment margins expanded from under 9% all the way up to nearly 16%.
Wow.
We are talking about a staggering jump in profitability for physical on-premise hardware in an era where everyone assumes everything is migrating to the cloud.
A 51% growth rate on mainframes sounds like a typo from 1985.
It really does.
But thinking about the mechanics of this, I keep coming back to the idea of a central nervous system. Like, if you look at a major global bank or a massive healthcare network, these mainframes are the brainstem. They might be totally uncool to look at, and nobody is writing breathless tech blogs about them, but they are practically impossible to rip out without killing the patient. They manage the most sensitive transaction rails on Earth.
That is a highly accurate way to frame it. You are talking about the bedrock transaction rails of global finance, logistics, and healthcare.
Right.
However, we need to update that mental image of the dusty server room. The surge we are seeing now is tied to the upcoming July launch of their new Z17 and Linux ONE 5 systems.
Hold on, let me challenge the timeline there, though.
Okay.
If the new Z17 hardware cycle launches in July, why did Q1 revenue spike by 51%? I mean, enterprises don't typically buy a massive wave of old hardware 3 months before the next generation drops.
That points to a really fascinating dynamic in enterprise IT. What we are seeing in that Q1 surge is massive capacity expansion and preparation.
Okay, so laying the groundwork.
Exactly. Clients are buying upgrades on their existing Z16 footprints to establish the infrastructure baseline needed for the new AI workloads.
Ah, I see.
They are locking in the architecture now, so that when the Z17 software and hardware migration happens in late summer, the transition is seamless. They are building the foundation for what the Z17 can actually do.
And what it can do is wild. The sources mention these new systems support up to 82 cores.
And 18 terabytes of memory.
Right, 18 terabytes. But the critical phrase in the analysis is that they process up to 450 billion inferences a day directly on the transaction rail. Let's translate that for you listening, because inference gets thrown around a lot.
It does.
Inference is essentially the moment an AI model looks at new live data and makes a decision or a prediction.
Yes, and the phrase on the transaction rail is the entire strategic pivot for IBM here.
How so?
Well, traditionally, if you wanted to run a complex AI check, You had to take your data, send it out over a network to a massive cloud server, let the AI analyze it, and wait for the signal to come back.
Which takes time and exposes the data.
Exactly. It introduces latency and massive security vulnerabilities. I mean, if you are a major credit card network, you do not have the luxury of sending live transaction data to a remote cloud to check for fraud while the customer is standing at the terminal.
No, you need that inference to happen in milliseconds.
Right. By utilizing dedicated AI accelerators built directly into the mainframe's architecture, IBM allows enterprises to run mission-critical AI workloads without ever moving the data off-site.
That changes the entire calculation for a chief information officer.
It really does.
It is not just legacy lock-in anymore. It is legacy lock-in that suddenly boasts state-of-the-art AI security built right into the metal. Why would a bank undergo the astronomical risk of migrating away from IBM's architecture when IBM just delivered the AI revolution directly to their existing, highly secured server room?
They wouldn't. That inherent security advantage creates an almost impenetrable moat. But, hardware is only the foundation.
Right.
A secure vault is useless if you cannot efficiently process what is inside it. That is where we have to shift our focus to the software ecosystem running on top of these mainframes, because that is where IBM is generating its high-margin recurring revenue.
Okay, let's talk about the software, because the growth there is significant too. In that same Q1 report, the software segment grew 11%, passing $7 billion.
Right. And within that, Red Hat, which manages their hybrid cloud infrastructure, was up 13%, and their data revenue surged 19%.
But the massive structural shift here is that Confluent acquisition. Back in mid-March, IBM closed an $11 billion deal to buy Confluent, which is a cloud data streaming company.
And that acquisition fundamentally alters IBM's value proposition.
Does it, though? I look at that $11 billion price tag, and I have to wonder if they're just overpaid to buy top-line growth. I mean, it feels incredibly steep.
It is a massive outlay, sure, but it is a critical infrastructure play when you understand the bottleneck in enterprise AI right now.
So does Confluent actually solve a tangible, immediate problem for these enterprises? Or is IBM just trying to, look like a modern data company by absorbing a buzzy brand?
No, it solves perhaps the most critical problem in AI deployment today. Confluent specializes in continuous data streaming.
Okay.
To understand why that justifies an $11 billion premium, you have to look at how modern AI agents require data. Traditional enterprise databases are essentially massive digital libraries. They store static, historical data. They tell you what happened yesterday or an hour ago.
It's the difference between studying a textbook on human anatomy versus watching a live MRI stream of a patient's blood flow. The AI needs the live blood flow to make an accurate, split-second diagnosis.
That is a perfect way to visualize it. If an enterprise wants to deploy an AI agent to dynamically reroute global supply chain logistics based on sudden weather events, or personalize a customer's banking interaction the second they open the app, historical data is useless. The AI needs live operational signals. It needs to know what is happening across the entire global network right this very second.
So Confluent acts as the central nervous system, delivering those real-time impulses directly to the AI model sitting on the mainframe.
Exactly. Confluent bridges the gap between static historical archives and live real-time data streams. By acquiring them, IBM now owns the plumbing that feeds the AI.
That makes a lot of sense.
When you combine that indispensable data streaming software with the on-premise computing power of the Z17 mainframes, you get a complete closed-loop ecosystem.
The hardware creates high switching costs, and the software becomes the mandatory lifeblood of daily operations.
Precisely.
Taking a step back to look at the market reaction, Wall Street seems to be fully digesting this closed-loop strategy. Looking at the pricing and the sources, the stock has been on an absolute tear, trading around $306 recently.
Yeah, the momentum has been incredible.
In late May, it rallied over 40%, hitting a record high in the $330 range in early June. And a massive catalyst for that particular rally was the announcement of a $1 billion federal quantum computing award.
Right. The quantum computing award was undeniably the headline that grabbed mainstream attention. It pushed the stock into aggressive price discovery mode.
For sure.
But beneath the confirmed federal contract, there is a layer of highly speculative momentum driving retail excitement.
I am glad you brought up the speculative side because I saw the notes on the fusion energy rumors and my sci-fi radar went off.
Oh, absolutely.
IBM is apparently collaborating with Oak Ridge National Laboratory and the Cleveland Clinic to simulate molten salt materials for fusion energy using their quantum computers.
Which is fascinating technology.
Now, I love the ambition, but are retail investors just chasing a shiny, futuristic storyline here? I mean, it feels like getting distracted by the promise of infinite clean energy while ignoring the fact that this is still fundamentally a hybrid cloud software business.
It is crucial to separate the narrative from the fundamentals. The fusion energy application is explicitly described in the analysis as early but promising.
Okay, early but promising.
It represents completely unpriced, speculative potential. It is the kind of visionary narrative that captures the imagination. However, if we look at the actual technical indicators driving the stock price, we see a much more grounded institutional reality at play.
So the smart money isn't buying based on a fusion energy dream. What are the momentum indicators actually showing us?
The analysis highlights the MFD, the moving average convergence divergence.
Right.
This indicator looks at the relationship between two moving averages of a stock's price. When the short-term trend line crosses above the long-term trend line and begins to accelerate away from it, it signals strong, compounding buying momentum.
Okay.
But more importantly, the 10-day average trading volume is running significantly higher than the 3-month average.
Which means this isn't just a handful of day traders clicking buy on a news headline.
No, not at all. Sustained high-volume participation accompanying a Man-CD breakout indicates deep-pocketed institutional accumulation.
So the big players.
Exactly. Mutual funds and pension funds are building massive positions. And analyst sentiment reflects this grounded confidence. Bank of America raised their target to $330, Barclays went to $350, and Wedbush set it at $320.
So the institutions are looking at the 51% mainframe growth, the integration of Red Hat, and the Confluent data streaming pipeline, and they are buying the core execution of the hybrid cloud strategy today.
Exactly.
The quantum computing developments are just providing a narrative tailwind, like a free lottery ticket attached to a highly profitable software business.
The market is pricing in the reality of the balance sheet and the immediate growth trajectory. But, as with any deep dive, we have to stress test the thesis.
Always.
If the hardware is surging and the software ecosystem is locking clients in, what are the structural risks? Where could this thesis break down?
So that brings us to the bear case, because there are some heavy financial anchors tied to IBM's balance sheet right now.
Yes, there are.
The most glaring issue is the debt. The Confluent deal was a strategic masterstroke, but it did not come cheap.
No, it really didn't.
Long-term debt has ballooned to over $56 billion, and that is excluding their internal financing arm. Total debt is sitting north of $66 billion against roughly $12 billion in cash.
Right. That is a highly elevated leverage ratio.
Yeah.
In a macroeconomic environment where interest rates remain, a major variable, carrying $66 billion in debt exposes them to significant financing and servicing costs.
Right. And when you pair that massive debt load with the recent stock run-up, you encounter severe valuation risks.
Definitely.
The multiple is getting stretched, their forward PE ratio is hovering around 23 times earnings, and the trailing PE is pushing 27. The market is essentially pricing in perfect execution.
Which is always a risk.
If they stumble on the Confluent integration, or if the mainframe cycle cools off faster than expected, that multiple could contract violently. But honestly, the debt and the valuation aren't the parts of the bear case that bother me the most. The glaring red flag in this source material is their consulting wing.
The internal lag. This is the friction point that many analysts are debating.
Right. The analysis points out that their consulting growth is sluggish, setting at just 1 to 4% recently. Let's really wrestle with this because it contradicts the core narrative.
How so?
Well, if IBM is genuinely leading a broad-based global AI transformation for the Fortune 500, shouldn't their consulting wing be billing out the wazoo? If every major corporation is terrified of missing the AI boat, shouldn't consultants be working overtime to build these custom solutions? Why is consulting growth practically flatlining while hardware and software are surging?
That disconnect is the primary point of concern for institutional skeptics. What we are likely seeing is something industry insiders call pilot purgatory.
Pilot purgatory.
Yeah. Enterprises are aggressively purchasing the foundational software like Red Hat and Confluent. because they know they need the infrastructure.
Yeah.
But actual deep-level AI implementation is infinitely more complex than just buying a license.
Because they have to integrate it across decades of fragmented, messy internal data.
Exactly. Integrating advanced AI models into a bank's legacy architecture involves massive hurdles regarding data governance, security compliance, and the very real fear of AI hallucinations in mission-critical environments.
Right, you don't want your AI hallucinating a wire transfer.
Exactly. So chief information officers are hesitating at the integration phase. The structural implementation takes significantly longer than the software purchase.
Okay, I see.
So the consulting hours aren't materializing at the same pace as the hardware sales.
They are buying the massive engine, but they don't quite know how to safely install it into the car yet.
That's a great way to put it.
How does the bullish thesis rationalize that massive consulting drag?
The mitigation factor is free cash flow. Yeah. Right now, the high risk in software and infrastructure growth is generating so much capital that it masks the consulting weakness. Management is fully aware of the debt load resulting from the Confluent acquisition, but they are still projecting roughly $1 billion in year-over-year free cash flow growth.
And they generated over $2 billion in free cash flow just in the first quarter alone, right?
Exactly. The consulting lag is a real risk, but the core cash engines are firing hard enough to absorb it for the time being.
When we pull all these threads together, the physical hardware upgrades, the aggressive $11 billion software bet, the quantum computing momentum, and the very real integration risks in their consulting wing, we have to ask why this specific stock matters to you, the listener, right this very second.
Right, the timing.
What is the immediate catalyst timeline?
It comes down to a convergence of upcoming product cycles and a shifting macroeconomic landscape. First, we have the Q2 earnings report scheduled for mid-July. Consensus expects nearly $18 billion in revenue. Because of that massive Q1 beat and the expectation that Confluent synergies are starting to materialize, Wall Street is highly anticipating a guidance raise.
And that earnings report leads directly into August, which is when the new Z17 mainframes hit general availability.
Exactly.
That hardware launch will be followed by associated software rollout waves in August and September. It is a 1-2 punch. An earnings catalyst followed immediately by a major product cycle launch.
Furthermore, we have to look at the broader market defense. We mentioned at the start that the NASDAQ was experiencing a rotation.
Yes, people pulling back.
In a risk-off environment where investors are taking profits from highly speculative, unproven AI startups, IBM presents an incredibly rare safe harbor.
Because it combines defensive stability with actual tech growth. The sources highlight their beta, which sits under 0.7.
Right.
That means the stock is significantly less volatile than the broader market. It doesn't swing as wildly when tech experiences a sell-off. And then, you layer on the dividend.
31 consecutive years of annual dividend increases,
Yielding nearly $1.70 per share. That creates a fundamental floor for institutional investors.
It does.
Even if the broader tech market throws a tantrum and multiples contract, you are getting paid a reliable yield just to hold the asset and wait out the storm.
Which perfectly encapsulates why the final investment thesis in our analysis assigns IBM an 8 out of 10 bullish score.
Yeah.
It is a rare beast in the current economic climate. It offers defensive, income-generating value through that reliable dividend, while simultaneously providing genuine, measurable AI-driven growth upside through its hardware and software monopolies.
It truly is a masterclass in corporate reinvention. We started this deep dive wondering how a century-old company was defying gravity in a shifting market.
And the answer is incredibly layered.
It really is. It began with that 51% mainframe shocker, proving that physical, highly secure on-premise computing is more vital than ever in the age of AI. Then they aggressively reinforced their software ecosystem, dropping $11 billion to own the real-time data streaming pipeline.
All right.
They threw in a $1 billion quantum contract to capture the imagination of the market. And they wrapped all of that innovation inside a defensive, dividend-paying fortress that institutional money flocks to when the broader market gets scary.
They chose to leverage their vast history instead of running away from it. They recognized that the deeply embedded transaction rails they built decades ago were not a legacy burden. They were actually their greatest structural advantage in the enterprise AI era.
Which leaves us with a final provocative thought for you to ponder as we wrap up today.
Okay.
In this frantic global race for artificial intelligence dominance, everyone is obsessing over the companies building the smartest, most conversational AI models. But if truly useful enterprise AI requires massive amounts of highly secure, real-time data processed directly at the source to actually function, might the ultimate winners of the AI revolution not be the shiny new startups at all?
Wow.
What if the real winners end up being the legacy giants who already own the pipes?
It certainly forces you to question the conventional wisdom of the tech sector.
It absolutely does. Thank you for joining us on this deep dive into IBM's 2026 strategic transformation. Keep questioning the consensus, keep digging into the mechanics behind the headlines, and we will catch you next time.